Hey everyone, welcome back to the channel, your number one source for income-oriented investing. And guess who I have back on the channel, Mr. Jay Pestricelli. And yes, that's how you pronounce his name properly, by the way.
You
Back
nailed
on
it,
the
man.
channel, yeah, from Zega Financial. So in case you didn't know, of course, we already know this. Jay manages or is a sub-advisor to not only Defiance ETFs, but of course, the YieldMax ETF. So Jay and his team manage all the options. So this is really the guy behind, they're the brains behind the strategy, writing the options. So this is who we need to talk to. Jay, how you doing, man? How you been?
Doing well, thank you. Great to be back. Appreciate the chance to talk again.
Of course, and just as an FY to my audience, this is not scripted in any way. It's not a sponsored video. I literally sent you an email like a week or two ago. Hey, you want to come back to the channel? You said sure. When and date and time, and that's it. So here we are. I always like that. You've been on the internet a lot. You've done quite a few Q&As, including one that I really liked so much that I even did a reaction video too, where you talked a lot about YieldMax and Tesla and the Nav Erosion thing and all that. So again, if in case my audience didn't see it, I'll put the link in the video description below, but we will catch up on everything. Let's start with YieldMax. We'll do Defiance later. So first of all, finally YMAX has launched the all-in-one fund of funds ETF that we've all been waiting for. So I saw on your website, I was going to ask you this question, but we already know it's an equal weight strategy. So can you tell me what is the rebalancing plan or the strategy behind that? When let's say a new fund comes in, are you going to rebalance right away? Are you rebalancing every month? How is that going to work exactly with the whole rebalancing concept, keeping it
Yeah,
equal
no,
weight?
great. Yeah, great question. And you're right. It's funny that you say we've been waiting for. Believe it or not, the premise behind us launching this fund was because our investors had asked for like, hey, can you just package one up? I'm tired of doing the rebalance myself, or you've
For
got
sure.
18 of these things out there now. So yeah, no, this is actually an investor requested fund. So we were happy to put it out. And you're right, equal weighted across the existing 18 yield max single name ETFs that we have today. They, you can do the math on the percentage there, right? I think it's like
Five
5.6% or something
something.
like that. And so the rebalance will occur as we launch new. Well, let's say first thing, we will rebalance monthly, right? So those ETFs are going to have their ebbs and flows naturally. So
Right.
just rebalance back each month, just bring every position back to kind of its that target 5+%. So now let's say we have a new ETF that's launched. Let's just say we launch one on, I don't know, GDX, right? Or Zoom. If one of those are out there, we're going to wait until they pay their first dividend. And then on the next rebalance, we'll bring them in. So there could be, in
Ah,
theory, I think we've seen times where we went live with an ETF, waited 6 weeks for the first dividend because maybe it was in the latter half of a month. We get a month, a full month of dividends. We get a month and a half, and then whenever the next monthly rebalances. So I guess in theory we could go as long as 9 weeks, but probably my gut tells me it's probably more in the range of 7 weeks before it finds its way into the YMAX fund of funds.
okay. So it's not going to be right away when a new one comes in. You're going to wait a little bit and then put it in. So yeah, monthly rebalancing, that's pretty often, more often than you would, than I usually see, which is semi-annual or quarterly. And that brings me to right away the management fee. You guys are actually adding a little management fee on top, 29 basis points on the YMAX. So obviously it's 99 plus 29. 99 is because the underlying have 29. So total
Yep.
YMAX MER is 1.28. And now I see why, because if you're rebalancing monthly and there's more work to be done, obviously you should be compensated for that. But typically when it's a fund of funds, there is no extra management fee. So what would you say to that? Or people who complain, hey, there's an extra 29, why are they doing that?
Yeah, so it's obviously an important question. Fees matter. We understand that for sure. So you're right. The first thing is the active management of the rebalancing, monthly instead of quarterly. I will say that there are some fees necessary to put out a fund, right? Exchange fees, auditing fees, accounting fees, all of those things in there. But the main thing that I think about where the extra added value is, realize this: there are times where we will want to harvest taxable gains or taxable losses for tax credits. So let's say, for example, the fund has an ETF and it goes down 25%. Well, you want to kind of take advantage from a tax perspective and close that out. But since you want to avoid the wash sale rule, which is kind of the reason that stops everybody from selling, taking the tax loss, and then rebuying, we, as the managers of the fund, can then actually replicate the option build of that YMAX individual ticker within YMAX itself. So you take, let's say we were to do it with, I don't know, pick another AI, right? So AI is down 25%. We close the AI ETF, and then we replicate it for at least 30 days with the normal synthetic build right in the YMAX fund. And so it's not so much, sorry about that, it's not so much that it's, the rebalance that takes more time. It's actually then replicating the strategy within the YMAX fund to fund itself.
Right.
So in other words, at times it won't be just the fund to fund. Sometimes it'll actually hold the option positions of the underlying YieldMax single stock ETF.
Okay, but when you say close out the ETF, it's not like you're kicking out an ETF from YMAX or anything like that. You're doing
No,
this
no,
just
no.
just to harvest tax benefits, right? And I'm assuming Rock is gonna come with that. There's a whole, we could probably do a whole other video on Rock and how there's so many misconceptions about it. People think it's just my own capital coming back to me. I've done a few videos on this. It's a load of baloney. You have to understand that Rock is just a tax classification. Maybe you could speak about this. I know it's probably a common question or concern you get, because I'm assuming, like the Tesla, for example, or the ones that have gone down, you're going to see a lot of Rock. Can you explain how
Yeah.
Rock is not just your own money coming back to you?
Yeah. And so for those that don't know, ROC is short for return of capital, right? And it's a classification that a dividend can carry. And so first off, I'm not a tax expert, and I will give you all the disclosures there that I'm not the one that makes those determinations. But here's how it happens. And by the way, very common in
Yes.
any options-based ETF. This is not just unique to YieldMax. This is very common across the board. So what happens is, let's think about the goal of YieldMax, right? Of any of the YieldMaxes. It's income, right? It's selling options for option premium to be distributed in the form of a dividend. So our goal, whether the underlying makes money or doesn't make money, is to return the income we make from selling those weekly calls. I know by this point, everybody on your channel knows we're selling weekly calls on underlying tickers.
Yeah.
Well, sometimes the underlying stock could go down, and the synthetic portion that represents the movement of the stock could realize a loss, right? We have options, we have to trade, we have to rotate those options and roll those on the synthetic side. Sometimes those realize a loss. And so let's take, for example, let's say a stock is down 6%, and we meanwhile sold calls during the month for 2%. I'm just picking out of the air. We're net minus 4%, right? The fund for that month is minus 4%, but we're still going to distribute the 2% yield we made from selling the calls, because that's our obligation to generate the yield. It's in the perspectives. It's our primary investment objective. But the stock lost, right? The ETF itself lost money. So that's what happens is, hey, even though you have a net realized loss of 4%, when we distribute that 2%, that gets categorized as return of capital, because the total of all the trades was a net loss. That's how it works.
Yeah.
And actually, there's a little benefit, right? I mean,
it is. And I've done a lot of research on this. I read many articles on this. What it ends up being is, I know you said you're not a tax expert. I'm not a tax expert either. But in Canada, for example, the option premiums, it's all capital gains. It's all capital gains. So if the ETF itself has a loss, either on your side, you guys do it synthetically. And in case my audience doesn't know what we're talking about when you say synthetically, in the YieldMax and even the Defiance, you don't hold the Tesla stock or the Google stock. You're not holding the actual stock. You're owning it synthetically. That's where the synthetic comes in, by having a long call and a long put, I believe, or short put. No, long call, long put, I believe, right?
Long call, short put. You got it. Yeah,
Long, I always get confused by that.
That's okay.
You're the expert. So you're holding it synthetically to track the price movement of the stock. So although you're not holding the stock, it's almost, you're basically doing options to track its price. But anyway, like I was saying, back in Canada, I mean, if the ETF is at a loss, You could offset those losses with those option premiums, and then instead of having it as capital gains, you have it as ROC. It's not necessarily a bad thing. It's just the option premiums looking like return of capital instead of capital gains. But return of capital is better because it's not taxable. So thanks for answering that. It backs up exactly what I've said in previous videos, and I hate talking about taxes. I don't want to spend too much time on that, but thanks for answering the question.
You're welcome. But it is a topic that comes up from time to
I'm
time, and
sure.
you're right. There's,
I'm sure.
it's worth addressing how it could even happen, and
Yeah,
it
a
all goes
lot
to the
of
goal of the funds.
Yeah, a lot of options-based ETFs have a lot of rock, especially in a bad year. There's a lot of rock. Sometimes it's all rock. So people think, what the heck is this? It's all, no, it's just the option premiums being transformed into rock as a tax classification. But anyway, back to YieldMax. You guys have 18 now, as far last time I checked, about 18 of them.
Yes.
Well, I mean, and I should have opened the prospectuses, but you have a lot more that are, being reviewed, I guess, by the SEC. You mentioned Zoom. I think I remember seeing Airbnb, PayPal. No, PayPal is already out, but there's maybe 10 more coming out. And there's even, you mentioned GDX. How come the ETF ones are taking so long to come? There's the gold one, the biotech one, and what was the other OARC you have already? Was the second one. There was a fourth ETF. I can't remember which one it was.
I think TLT, right? The
TLT,
Treasury was the
yes.
underlying one, right? So look, those are all, I'll be 100% honest, they're business decisions on where we think there's interest. An ETF is in of itself, you want it to be successful. You need to gather assets so that it can self-sustain, right? Where the fees that are generated on the ETF can offset the cost to run the ETF. What a lot of folks don't know, and maybe this is a little too inside baseball, it could cost $250,000 a year to run an ETF, just the fees associated with executing and operating it, right? Even more depending on certain circumstances. So, when you think about that, you have to make a decision on, hey, is the market interested in this particular ETF? And that's why we went live with, some very popular names out of the gate, like Tesla and ARK, of course, at the time was still very popular, still is. Apple, most widely held stock, like, great. So there's a business decision associated with that. When it comes to the gold miners or even TLT, for example, TLT, there's an existing kind of covered call ETF. And we're not saying we'll never do one, but there's one out there, right? It's already kind of satisfying an investor need.
Yeah.
While we think the YieldMax approach might be better, in certain circumstances, there are other opportunities, right? I think there's a GLD might have a covered call strategy. Now, for us with the gold miners, there's always a little maneuvering here when it comes to the way you name things, but basically we need to do kind of a little refiling, a little press conference or a little press release. But I do see that as one of the sooner scheduled launches for the gold miner YieldMax version. So I think that's probably in the queue. I did mention Zoom. That's one that's, a popular stock, although it has lost some popularity lately, but it's volatile. And so again, the other thing that matters is what? Our yield. It's
Volatility,
YieldMax.
yeah.
Yeah. I mean, Berkshire Hathaway was one of the first stocks that we filed for and got approval for. We even have accounts open to trade it, but like there's no real benefit yet. There's no juice, right? There's like a 5% yield to do a YieldMax on Berk. So until that changes, we don't know if we're actually putting out a product anybody is looking for right now.
Yeah,
right?
you're right for sure, because there's a Canadian company called Purpose that's doing, and they have Berk and it's their least popular one. So you're absolutely right.
They went live. That's the one that had the most seed money too, right? It started out with the most, and then it grew the least. So, like we're just cognizant of what the investors are looking for. So the same reason why we fast tracked YMAX, because it was being asked for by investors. Some of the other ones are less requested. So I would say those are the universe of like single ticker bullish covered call strategies. There are other strategies that we have filed for. Along with the YMAX, there was a YMAG, which is a Magnificent Seven.
Yes.
That one is effective, which means I could talk about it, and it's gone through the SEC review time period. But maybe that's one that we go live with shortly, which is just the Magnificent Seven, which we know is, see if I can rattle them off fast, right? Apple, Google, Facebook, Amazon, Tesla, Nvidia, and who's the one that I'm missing there? I'm
Did you
missing
say
one of them.
Amazon?
Maybe I did. I don't
Anyway,
know. Amazon,
yeah,
Meta, Google. Yeah. Oh, Microsoft.
Microsoft,
Microsoft.
right?
Yeah. So those, right. So that'll just be a yield max of the Magnificent Seven. So same thing, equal weighted, just like Y max. It'll be Y mag. So again, it looks like there's some demand for that. So maybe that's something we see shortly. The other thing that we've you're right. This, I don't want this to be a commercial. I want to make sure we're answering all of your questions. But we have some other innovative strategies that have been filed for. We have inverses that have been filed for. We have a version where we are not constrained by a particular ticker, where we could build a basket of, any 20 stocks that we want that happen to have high volatility, right? There is a version of that that's coming as well. The ticker for that is ULTI. It's YieldMax Ultra. So,
Wow.
all of those things are kind of coming down the pipe. We are not sitting on our laurels. We want to continue to innovate and give, put out interesting products.
Okay, so is it safe to say that even though you'll see some ETFs and tickers in prospectuses, not all of them are actually going to come out? Is it safe to say that you're really doing out based on demand and feasibility?
Yeah, I think so, right? No, even the SEC would argue, like, why would you put out a fund that has no interest, right? So, but
Yeah.
we will kind of continue to assess that. Yeah, will we absolutely do every single stock, everything we file for? Probably not, right? I can't,
Okay.
it's
That was
probably
my,
more
yeah.
of most, not all.
Okay, so YMAG, by the way. So YMAG has all the, seven, which is kind of already in YMAX. So when YMAG, the Magnificent Seven one comes out, are you going to be adding that to YMAX or no? Or these other
No,
ones?
yeah, Y max will not hold Y mag, right?
Okay,
They'll hold the same, those seven will be in the
they're already
Y
in there.
max.
Yeah.
Yeah, but they won't,
Okay.
no, Y max will not hold Y mag. No.
What if you have, like you mentioned, some newer inverse stuff? Will that be added to YMAX or same thing? No, you get it separately.
Those are separate because Y max is the prospectus talks about covered call, meaning bullish base. So an inverse doesn't qualify. But maybe at some point, if we have enough of the inverses,
An
we put
all-in-one
out,
inverse.
a Y min. I don't know, like, I don't know, the opposite or something. But today we'll see what the appetite is for the inverse versions.
You're kind of blowing my mind. I'm very excited to see all this stuff come out. I mean,
Thank you.
why not? Why not do the inverse and which I'm assuming is going to be puts, or I don't know if you could
Yeah,
talk about it yet.
that's right. So again, this is something that's been filed, so not 100% effective. But what the prospectus says is it will be the inverse of what the Y max looks like. So we will be long a put, short a call, so a synthetic short. Now, because you're short a call, you have to buy another calls for margin reasons. So you're not naked a call. Nobody wants to be naked anything, right? So we're not naked a calls. So it's a synthetic short and then sell an out of the money put, which is below the price of the market, right? So maybe you're selling 5-6% out of the money puts, just like how we sell 5-6-7% out of the money calls on the
Right.
traditional YMAX.
That's awesome. A
Yeah,
lot of
it'll be a
people are
fun
going to be.
construction.
Yeah, that's cool. A lot of people are going to be happy because a lot of my audience members ask me, so many call ones. Where are the put ones? Well, hey, some put ones are coming, and
There you go. I don't
let's.
know a lot of strategies out there that lets you be, inverse and then have, this, high end dividend, right? I mean, I think that'll be interesting, and I'm particularly excited about that one because I don't think there's anything that exists like it today.
Same here. I mean, it's incredible. Not much. Even on the Canadian side, there's a few, but you could count on one hand the put ones. So yeah, it'll be fun to see. Let's talk about a question that you probably get a billion times. You talked about it in that Q&A that we talked about earlier. That NAV erosion. So the test, we'll stick with Tesla, the Tesla one, for example, right? It will follow what Tesla does, and you're paying out all the income. So obviously over time, and this is what I explain over and over with these really high yielding funds, you got to expect varying distributions and most probably slightly reduced distributions over time in stock price. What would you do in case it just goes too low? A lot of my audience members, they keep asking me, like, they see a downward trend. Is it just going to go to zero? Would you consider a reverse split or something like that? What would you say to that? Probably number one concern you get.
All right, so the split, the 5-letter word, right? Split is certainly a topic that comes up from time to time. So it is something that we look at. I think look, by the way, ETFs do reverse splits all the time. Typically the leveraged ETFs do this, and that's because they have what I would actually call NAV erosion. I actually wouldn't consider what we experience in YieldMac as erosion. It is the common term that everybody uses. So,
Yeah,
I'll allow it, like you care what I say. But I think that it's one of those terms that this is the function of the high yield and the covered call tactic, right?
yeah.
Where you take all the downside and only some of the upside, all the downside, some of the upside, and then you get paid for that, that dynamic. So to your question about split, though, it's certainly something that we know that we need to be on the lookout for. We don't want the stock, the ETF price to drop to 5, 2, 3, $1. Like that's just, it makes it difficult to operate, and for a lot of reasons, you lose things like margin on it, and people start to lose confidence on it. So from a tradability perspective, I think it's probably fair to expect that some of the YieldMax ETFs will have a split.
A
So what
reverse
does that
split,
mean?
you mean?
A reverse split,
Right.
right? So let's say, Tesla's at, Tesla is at $9 and we do a 1-for-2 split. You would double your shares. Sorry, you would lose half your shares, but we would double the price.
Double
So
the
if you had
price.
30 shares, you would now have 15 shares, but at twice the price. And so what's really important to realize is your portfolio position doesn't change, right?
Yeah,
It's just a swap. Hey, I used to have, 5 singles. So I had 5 bills in my hand worth $5. Now I'm giving you a 5 and you have
yeah.
1 bill, but it's worth $5. Like that's the idea behind a reverse split. Tactically, it's one of those things that we will definitely notify the community. We will do I think we have a 10-day minimum notification when something like that is going to come up. So we'll make sure we notify the investment community that this type of thing has happened. There'll be a lot of FAQs associated with it. So it is something that you're right, just because of the dynamic of
Could
some
happen.
of the price movement of the underlyings, you're going to have a decline in NAV because you're paying out so much in yield. Plus, you get that whipsaw with some tickers like Tesla.
Yeah, it's important. You nailed it on the head when you say your account value is going to stay the same. This is why I don't understand when there's always a freak out when there's either a reverse split or a normal split. Doesn't really mean anything. Your account value stays the same. So it's important that people understand that it really, in the end, doesn't really mean anything. It's not a positive thing, not a negative thing, in my opinion. I'm just saying account value stays the same. Whether you have 5 $1 bills or a $5 bill, it's the same thing.
Yeah,
So
and the yield won't change either, right? You'll still get the
yeah, yeah,
same
yeah, yeah.
percentage, right? And that scenario where let's say you were going to get 50 cents in a single month for Tesla, well, at a 2-for-1 reversal, then you should get $1,
Dollar,
right,
yeah.
in your dividend, right? But it'll be the same percentage that gets distributed.
Okay, so just to wrap up the yield max, we still have to talk about the Defiance ones, which I have a lot of personally. What is, have you thought of doing a covered call on Bitcoin? Now we got Bitcoin ETFs. Is there a yield max Bitcoin coming out? I know you can't talk about it. Are you guys, have you gotten interest on that? I'm sure you have, right?
We definitely have had requests and interest on it. It is definitely something that is of top of mind for us. So I think, to be continued on that one, but it fits into the universe of things that we're doing in YieldMax, where you take popular underlying assets or tickers, right? You can generate an amount of yield and there's options markets on it. It fits into all of the things that we would consider when selecting, kind of an underlying to run a YieldMax strategy on.
Glad to hear that. Glad to hear that. Last question. In Canada, we have a lot of these. There's leveraged ETFs, like 25%. Typically, what they do is they just hold 125% of the underlying ETF. So, would you guys consider like a leveraged YMAX where you guys handle the leverage? And I know we talked about this before, and you're like, well, we prefer that you do your own leverage. But I have to say, on behalf of myself and the community, we are extremely, because you take requests seriously, extremely interested in
Yeah.
that. And I will tell you, I will make the promise to you right now live. If a leveraged version of YMAX comes out, even if it's like a 10% or a 25% leverage, I will invest personally 100,000 in it.
Wow, that's
With
good enough reason for us to do one right
I
off the
hope
bat.
I'm trying to motivate. So within the next year and a half, because I'm,
All right.
anyway,
Yeah, yeah. So
what do you think
today
about that?
Yeah, so look, I'm with you as an options guy. I love using the dynamics associated with options. Leverage is a very easy thing to implement within the yield max structure, right? It's like, hey, do a few extra contracts and you're creating notional leverage naturally, right? But today, there is no there. I would tell you that it's not something that we are considering at this point, only because we understand the dynamics of leverage. It's not a no forever. It's not, it's just a not now.
Okay, I'm still hopeful.
Yeah, I look, and look, this is great. That was completely unplanned what you just threw out there. This is one of those things I bring back to the
Yeah,
partners
I
of
mean,
YieldMax and we talk about it.
my reasoning behind it is because I'm a long-term buy and hold investor. When I buy something, I want to hold it forever. So why not have a leverage and a bit more of a boost? It's just the way I look at it. So thanks for answering all
And
those
with,
questions
yeah,
on the
you're
yield
welcome.
max. Sorry, go ahead.
No, no, I was just saying, look, the yield is going to get leveraged too in that scenario, right?
I
It
mean,
gets
can
the
you
yield even
imagine?
more
I
attractive.
mean, it's mind blowing to me. I mean, what are we gonna have on YMAX? I mean, YMAX, I'm assuming, the first distribution hasn't been declared, but it's really an aggregate of all the. I did it actually all myself. I added up all the yields. I got to about like 40 or 50 or something. It was really high because a lot of these, like Connie and the AI one and Square, these are rocket yields. But then you have like the Microsoft, JP Morgan, ExxonMobil, which are a lot lower, but the average was still like 45 or 50. So imagine a little bit more. Like we're talking like crazy yield. It just blows my mind. So anyway, super interesting stuff. Moving on to Defiance, you guys also
Sure.
manage the Defiance ETFs. You're the option advisor. So I'm talking about QQQY, JEPY, the Russell one as well, IW, I always mix up
IWMY. Yep,
MY.
yep, you
Okay,
got it.
so in the Q&A you did, and maybe you could just confirm this real quick. I don't want to talk about because you already talked about it. How really the Defiance ETFs are kind of the same as the YieldMax ETFs. And I was so happy to hear you say that because that's what I feel. In the money put is really the same kind of thing as an out of the money call. Can you just confirm that how really the Defiance ETFs are pretty much the same except instead of a single ticker on ETF, you're doing it on the index? Nasdaq
Yes,
or S&P.
so I will confirm the structure of an in the money put
Yes.
is the same option structure as a covered call at the same strike or a synthetic call at the same strike. The P&L chart looks the same. The hockey stick looks the same, right? Because it's, you've got the up movement and then it flattens at the strike.
Yeah.
It's the exact same look of an in the money put. A lot of folks think, puts, oh, you're supposed to sell out of the money puts because you're like selling as a limit order, and as it goes down, you could get assigned. That's true. That is a more popular tactic to use with puts, or if you're hedging, you buy an out of the money put. But a lot of folks have missed the fact that an in the money put replicates a covered call. It's actually, I'm going to use a term that, maybe it doesn't apply all the time, but I actually think it's a much more elegant solution to the covered call, the synthetic call. Now, there's a few things about that. The first thing is with Defiance, we are selling options daily
Yes.
on an index, and those options are cash settled. So there's a little difference of the underlying between an equity option and an index option. They are treated a little differently, European style versus American style. That has nothing to do geographically. It's just whether you could be assigned early or only assigned at expiration. So all of those things together, while it is true that it replicates the covered call strategy, there are some other pieces like doing it on indexes that actually even make it more advantageous to do the in the money put.
Yeah, yeah, I absolutely, and I made like one or two or three videos. Even so, we're filming this by the way on the 23rd. It's gonna come out Sunday, but Saturday I have a video where I say why I went all in with the Defiance ones instead of the Yield Max, and I really love the option strategy better because it's a daily. So there's less of a chance, instead of doing a weekly or a monthly like the Yield Max. I not only that, but I also like that it's on indexes. I love, who doesn't love the S&P and the Nasdaq indexes, right? Really, really awesome. I really love those strategies. So thanks for confirming that. And by the way, this was actually a member question. Are you doing always 1 day options? Or are you would you do 7 days as well on the Defiance, or is it a mix of the two? And but it's primary a 1 day option. So what's the like? Can you go into details of the option strategy, the time frame on that?
Sure, sure. So the prospectus gives us the ability to do 1 week or less,
1 week or
but
less. Okay.
1 week or less.
Okay.
But we generally, and by generally, I mean nowadays, and I'll explain why I say that, generally do 1 day till expiration. And the reason we do that is the way that time decay works is it's maximized, especially with the at the money options, which is kind of what we're doing here, though slightly in the money options, I would say generally are at the money. Those options have the most rapid amount of time decay. So in other words, if I did a 3 day option versus a 1 day option, I might be able to sell for 25 basis points 3 days in a row versus a 3 day option, but by the way, those 75 bips, that 3 day option, I might only get 50 bips, 45 bips, right? I might not be able to get all of that time decay. And again, the primary goal of these is income, right? Income is the primary goal of these. And so if I can do 3 1 day trades and get paid more than doing 1 3 day trade, I'm going to do the 3 1 day trades. Now, why did I say in general? So there are times up until now, there weren't daily expirations on the NASDAQ and the Russell. The S&Ps had daily expirations, PM settled daily expirations since back to July of 2022. But the NASDAQ didn't put out daily options until October of 22, but they still don't have a PM settled option on the monthly. So remember the old school options, hey, once a month, third
Once a
Friday,
month.
the AM settled. That is still the only option that exists on that Friday. We just had one on January 19th. So in those scenarios, I don't want to sell an option on Thursday, the 18th, that expires the morning of the 19th. So in those scenarios, I will go to Monday, right? So in that time, I'll go like 2 full days. Same thing for the Russell. The Russell just went live with dailies. They only had Monday, Wednesday, Fridays up until really just last week. I think we had something to do with that because we're familiar with the product managers. We said, look, we really want to have dailies. We were probably just the excuse they wanted to push us over the edge. I know the product manager always wanted it, but now same thing with the NASDAQ. Every day except the option, except the monthly option has a PM settled. So when it comes to the third Friday or the third Thursday, it might not be the third Thursday, you'll then see us do a 2 day trade. So, let's say 19 out of 20 times we expect to do a 1 day trade.
Okay.
There's at least 1 day a month that we'll do a 2 day trade. But in general, we know that you get more rapid time decay doing a daily option.
Yeah, and okay, so a lot to unpack there, a lot very technical. Can you say when you say time decay, you're trying to capture more time decay? It's kind of like saying you're trying to capture more premium,
Oh, yes.
right?
Sorry. So yes, there's
You're
two.
trying to get more income, more premium, right? Because I love the example you gave. If a 3 day gives you 45 bips, but a daily gives you 25, which is 75 total, you're gonna go for the daily one. So that kind of explained that's how I understood it. So generally, most of the time, as much as you can, you're gonna do the daily, but sometimes for whatever reason you'll do maybe a 2 or 3 day one or something like that if you have to, but there's no another question I got that could be related about the distributions going down, which we'll talk about it. Do you feel like there's enough of options market on these dailies on the S&P, the Russell, and the Nasdaq, or is it getting like oversaturated? What's your opinion on that?
Yeah. Okay. So two things. So, by the way, apologies for getting really technical on the
No, that's
daily
okay.
stuff. The when it comes to the lower distributions, this is absolutely a function of volatility in the marketplace, right?
That's what I
When we
thought.
launched the Defiance funds, the first two in late September, guess what? The market had a higher implied volatility, right? The VIX was higher, the
Yes.
market was a little dicier, a little scarier. So you could sell options for more each day because there's a more implied move. Like there was, hey, maybe we're going to move 2% today or 1.5% today. Whereas today, with a VIX of, I think, 13, it's got a 13 handle, right? So with the VIX of a 13 or 12, you can't get as much premium on the options that you sell each day, with the exception of, I'll give you an example, like before a Fed day, right? We'll see option, premiums jump. Before a jobs number, right? We'll see option premiums jump. But, this week, we're kind of running smooth, volatility's on the low end, those options we'll sell for less time value. And again, the goal of these is to distribute the time value we earn, the extrinsic value we earn, the option premium we earn in those in the money puts. And so if there's less volatility, you're going to have a lower dividend. So that's really the answer.
It's not about that there's an oversaturation, there's a problem with the strategy, this and that. It's 100% based on volatility, right? Because this is a main concern that I've been getting. Obviously,
Yeah.
it's a legit concern. You see a dollar, QQQY, let me just bring it up here real quick. $1.10, then $1, then 93 cents, now 62 cents. And JPY, the S&P one, 90 cents, 91 cents, 65, then 50. And I was actually curious about that. So I actually brought up the VIX chart and I saw that, even 3-4 months ago, the VIX was like double. It was like,
You got it.
It was like 20 or 21. And now it's like so low because the market's been really boring. So it's not can you just confirm again? It's not a function of problem with the strategy, problem with the fund, problem with the options, not enough options, not enough whatever. It's purely just volatility and it's 100% normal.
Yes, so I will confirm that we are not influencing the premium of the S&P or NASDAQ or Russell options, certainly not at these sizes. I think you could add 3 zeros to the end of our AUM and we still wouldn't impact it. Those are huge option markets. And how do I know this, right? Let's take a strategy you've talked about before, JEPI or QYLD, right? Kind of the OG covered call ETFs, right? They do like a $5 billion trade once a month. You don't even see a blip in the NASDAQ, right? JEPY's 30 billion in size.
30 billion.
I know they have multiple tranches. They don't impact the market, right, when they do their roles. So it's one of those things that it's not just because I think it's because when I look at what else is out there on funds that are, literally 100 times larger than ours, they're not moving the market in the exact same, indices that we're trading.
Wow, that gives me a lot of confidence. I'm sure people are watching. I never had that worry because it's the S&P 500, it's the NASDAQ 100. It's not like a single stock. It's like the whole world. I doubt you'll ever have a liquidity problem. I guess people are worried about a liquidity options problem or something like that, but you just confirmed it by saying what you did. So I really appreciate
I'll
that.
add one other thing, right? We go to multiple market makers when we do these fills, right? So we don't go to a single source. We trade directly to the street with some of the biggest names. And they are, absolute, but they're all filling at very, very similar prices, right? It's not like, oh, this one guy's, always lagging, or this one's, wow, really opportunistic. They're all coming in very, very similar, which tells me it's a stable market.
Okay, perfect. Thanks. I'm just looking through my notes, making sure I don't forget anything, but you pretty much answered everything. The Defiance, the main thing was to confirm in the money puts and out of money calls about the same thing. And the biggest concern or feedback I got, the lowering of distributions. And like I suspected, it has all to do with volatility. By the way, the VIX, I know that's S&P 500. Just a personal question for me. What about the NASDAQ? Is that also influenced by the VIX, or is there like another NASDAQ VIX, or it's the same thing?
There is. It's VXN.
VXN, okay.
VXN is for the NASDAQ, and then the Russell, it's RVX.
RVX.
So they all have their own volatility indexes, but it's a function. A lot of charting tools will also show you the implied volatility of the options. The one thing I would say about those indices is they are 30-day VIXs, right? Which means they look at from 0 to 45 usually, and they say, okay, let's aggregate all of the options in this range. And that was done when there were only monthly options, right? Now we have daily options. There are VIXs with much lower time frames, right? A 9-day VIX, you could take a look at those. Those will even be more correlated to the distribution rate for the Defiance funds.
Yeah, I see a bunch of smaller channels trying to predict the dividends. I'm like, why are you even doing that? But anyway, it's fun. There's a lot of speculation with these funds, even though it's like kind of a boring fund if you think about it. QQQY, I keep saying it's kind of the same thing as a JEPQ, and JPY is kind of the same thing as a JEPY or a SPY. I mean, the underlying is the same. It's not. People say it's so much more risky than a JEPY. It's not. It's just a
It's
different
not more
strategy.
risky, right? It's just
It's
the
not. It's not.
structure is more simple, right? The
Yeah,
cash settled, all we're doing is taking
I
index
love it.
risk. It's not
I
leveraged.
love the daily because it's daily. I really like that. I find it's a superior option strategy. You kind of admitted it. You said it a few times yourself here in this Q&A. So just real quick, distribution policy, same as the yield max kind of, you're giving out all the income.
Yep, the goal on those is we're giving out what I would call the extrinsic. So there's a little difference with an in the money put,
Yeah,
right?
you talked
There's an in
about
the
it
money
in the
put.
other.
There's two parts, right? You've got your
Yeah.
extrinsic part and then your in the money part. Actually, I go the other way. So the in the money part is the price of the index to the strike price. That's just whatever the underlying index moves, we'll capture that.
Yeah.
The extrinsic is the, the implied volatility, the time juice, but really they're both in the premium. So we don't distribute all the premium. We actually calculate of the option. Like let's say an option was 0.5% in the money, and we sold that for 40 basis points. In that scenario, and let's say it expired worthless, right? We earn all 40 basis points. We're only going to distribute the 15, right? 40 minus 25, only going to distribute the 15 of time value, of extrinsic value. That will be the dividend. We're going to hold as long as we can that in the money. I'm going to call it the underlying index movement as long as we can. At the end of the year, if that is net positive, we'll distribute that as well. But up until we approach the end of year, the end of tax year for the funds, and those are not always the calendar years, it might be October. Up until that point, we're only going to distribute what we earned in the extrinsic sales. So for you options geeks out there, right, there's intrinsic and extrinsic. The extrinsic is what I would call we always refer to as the time value. It's the same thing as what the in the money call amount would be if you just sold the call. The upside capture is what that in the money portion is.
Yeah, so I understand. Let me try to translate it in case people don't understand it. What you're distributing is the money you're making off the premiums. It's the premiums. It's not, let's say the NASDAQ goes up or the S&P 500 goes up. You're not distributing that part, the part of the index is going up. You're keeping that in the fund. That's why you see JEPY go up and QQQY go up when the NASDAQ or the S&P 500 goes up. You're giving out just the option premiums, kind of the time decay.
The time portion of the premium. You're right.
Okay.
Because there's two parts of the premium in that scenario.
Yeah, it's a little bit more complicated with the Defiance ones to explain.
It is
because it's but I kind of like the yield max. You're giving out just the time decay or the premium. So
you got it.
Oh yeah, and by the way, maybe I'll have to tell Sylvia about this, but I am also extremely interested in a leveraged QQQY and JPY, and if one does come out, I'm switching to the leverage one right away. You have my promise on that, and I have about 200K of my own money in these, so it's a significant portion of my
no, thank you. That's great. That's
personal
a real vote
portfolio.
of confidence.
I have it on drip, and I'm kind of showing people how what you actually confirmed on that other video. It's all about you're overthinking the QQQY and JPY, in my opinion. You're looking at the stock price and the decay of that, but I invested 100K in JPY and I put it all on drip. Now my investment's worth 110. I put 120 in QQQY and now or maybe it's the opposite, and now it's $10,000 more. So like you keep saying, it's all about portfolio value. And if you want to maintain that, you got to reinvest your dividends, or at least a portion of it. My argument, and I made a recent video about this that kind of took off. These are not really the best funds to extract everything to live off of to pay your mortgage. You talked about that, right? Like, don't take everything out of Tesla and QQQY and pay your mortgage. You can do that, but it's kind of like selling off your investment. So hopefully I try to show with my example that if you do reinvest everything, your investment goes up, your account value goes up. Any final thoughts on that? Because I know you explained it a billion times already.
Yeah, you got it, right? So it's maintained. That's the allocation. Otherwise, you're right. You're just converting your position to cash if you don't reinvest it.
Yes.
The other thing I would say is your dividend now, because you have more shares,
Yeah.
right? Not only do you have more value, you also have more shares. And so because the funds have appreciated on a total return basis because the market has moved up. So not only are you getting the high yield and you're compounding those, the value of your shares is probably also, things are appreciating in the total return aspect. That's why your position now is 110 when you started 100. Your dividend will also then go up based on the number of shares you have, but your
Yes.
rate, is still based off that higher balance. And so by maintaining the position balance, you get the rate you want. So even though I don't, I should have looked, let me look for 2 seconds here. I'm just going to pull up the price of QQQY, right? It's
Yeah.
17.90 right now, right? We launched at $20.
Uh,
When we have, a distribution, even though it might be lower from you quoted the cents per share,
Yes.
that might be lower. It's a higher percentage, and you have more shares, and you have a bigger balance, so the yield will be more maintained that way, right? It's
Yeah.
all linked together. It's why drip matters.
Exactly. It's all exactly. I invested in both of them at $20 a share. Now they're at 18, but my investment is higher. How do you figure that, right? So that's why I keep saying or keep telling people it's really about that dividend or that income. Don't just spend it all. That's part of your investment. If you want to live off this stuff, you can, but you kind of got to do a little bit extra portfolio management. But I'm just gonna turn the drip on, let it go. My plan, let it go for at least 10 years. And maybe it'll be $15 or $12 or $10, but I'll probably have thousands and thousands of units. So that's what maintains the value, makes it go up. So I totally get it. I could only show my example, and I unveil my portfolio every month. So
That's great that you do that, and you can, show people by example versus people theoretically,
it's
making
harder
assessment.
talking about it because I've tried many like you have, but I feel it's easier just showing my portfolio every month and say, look, look every month, and then it starts clicking because it's not exactly the easiest thing to understand. It takes time and experience, but as an income investor, I get it. So
Yeah, it's true. Like, well, even though the strategies are in an easy to purchase wrapper like an ETF build, there's still an options tactic underneath, right? And so
yeah,
you still, if you're going to buy these, you should have a little bit of an understanding of what the in the money put or the out of the money synthetic call is doing to understand how to properly use them. And look, I get it that we could be accused of taking a complicated strategy and making it too easy for the average investor to buy. But my counter argument is, yeah, but we've made it really easy for people to now get access to a strategy they didn't really have before. So the active management, the zero DTE options, like this is all pretty innovative stuff. We're really happy to bring it to the market.
yeah, and you could do all this stuff on your own, right? Whether it's selling calls on Tesla, whether it's doing the daily, but
Sure.
that is why you're paying the management fee, which is, I find it's not super exuberant. Obviously, it's going to be much higher than a passive index ETF. They don't do any work. There's a lot of management. I mean, you're doing this daily, you're checking the days. It just drives me crazy thinking about doing it myself. Happy to pay the fee and let the pros do it. That is really the point of these ETFs. That's another argument I hear about the management fee. Yeah, well, it's a lot of work to do. So, Jay, keep up the good fight, man. You're going on all kinds of channels. You're repeating the same stuff, and I like that. I feel like we have a good rapport, and you're trustworthy because you're kind of always saying the same thing, which is good because you're
I'm
not.
not mixing the message up a little
No,
bit. You're
you.
right.
So
Well, and in all fairness, right, to your audience, this, you were the first, right? You were the first that came to us and said, we
I
really want
love
to
that.
talk about this. So thank you for your ongoing support. And yeah, I've always enjoyed our discussions here. So thank you.
Yeah, I appreciate it. We'll have you back for sure. It was nice talking to you. Thanks for taking the time. I know you had a meeting, you delayed it, but you're awesome in that. And again, no script, nothing. I'm gonna publish this Q&A as it is, and I'm sure the audience will appreciate it. So thanks again, and looking forward to hopefully the leverage stuff in the future.
I'll
I'll have
talk
you
to
back soon.
Sylvia about it too.
I will. I'm gonna have to email Sylvia. Like, come on, Sylvia, let's go. It's the Nasdaq. It's not that risky, or the S&P. So, thanks again, Jay. Take care, my friend. See you
You
soon.
got it.